Welcome to DeFi Crypto today. Our topic today is Yield Enhancement Labs, also known as YEL. This is a very interesting project that basically creates the equivalent of an ETF, an exchange traded fund for crypto. And you have different risk levels, and it's available on multiple chains, including Fantom, Polygon, Binance, and soon Ethereum. And it doesn't work like a regular farm. And we're going to see the difference. And you're going to see that you have 3 levels of risk with very interesting APYs. So let's have a look at the Fantom. I'm going to use Fantom because I like Fantom, and it also offers the best yields right now. But if you prefer Polygon or Binance, you also serve with several very sexy APYs. Okay. All right, so let's have a look at it, and then I'm going to explain a little bit how it works under the hood. And you'll see it's different from a typical farm. Okay. They have their own token, but it's not issued the same way as a regular farm token, so it's not as inflationary. The way it's designed, the token should go up in value the more you earn, and we're going to explain that in a few minutes. All right, so let's start by looking at what they're offering. So you've got Spectre, Equilibrium, and Governance here. The ETF-like system is on Equilibrium. Spectre is staking the YEL token, and Governance, well, that's because it's a decentralized autonomous organization, a DAO, so you can vote on governance if you hold the YEL token. Anyway, so for us right now, we're going to focus on Equilibrium, which gives really amazing yields, as you're going to see. All right, so we got 3 levels of risk. I don't know how they came up with these names, but anyway. So you got the H2O, which is the lowest risk. And right now, it gives you a 190% APY on Fantom. These rates will change every few seconds. Remember that. It's not fixed. It's not cast in stone. Nothing's fixed. Nothing lasts forever in crypto. Remember that. So, and then if you click on this, it tells you what they're investing this fund in. So it's on 2 LP pairs, USDC Fantom and DAI Fantom. So those are fairly low risk. Okay, essentially you've got stable coins with Fantom, and you're going to earn 190%. That's really good. That's very juicy. We're going to explain how they achieve this in a moment. And then you've got the medium risk. You got Tesla. Again, how they come up with the names, no idea. Strategy used. So these are considered medium risk protocols. So you got the Spell USDT, Spirit Fantom, Boo Fantom, and Ice Fantom LP pairs. So they're investing in all 4 of these in this pool to maximize the earnings, and at the moment you're getting 345% APY. And as well, you've got the Frankenstein. This one I understand a little bit more because it's more degen. So the strategies used are Geist Fantom, Pills, MIM, Tomb Fantom, T-Share Fantom, and YEL Fantom LP pairs. Okay, and that's why you're getting a fantastic 6,733% APY at the moment. And that's what we're going to use today. We're going to demonstrate this one step by step. It's pretty easy to do. Now, this is a deprecated pool, so if you've got money there, take it out. It's not going to earn you much. All right. So, for those that don't know what an ETF is, I'm going to show you a stock market ETF, one of the biggest and most popular ones. It's from Vanguard. It's called Vanguard S&P 500 ETF. So ETF stands for Exchange Traded Fund. So it's a mutual fund that's traded on an exchange, like the stock exchange in New York or the NASDAQ or whatever. Okay? It acts like a stock like Apple stock, Tesla stock, Google stock, whatever. But its purpose is to invest its money into a very large pool of stocks. In this case, their strategy is to mimic the S&P 500 index. So they're going to buy exactly the same stocks in the exact same quantities as the S&P 500 index. So when you buy this, it's going to reflect the price fluctuations of the S&P 500 index, or at least it's going to try. It's going to be very close to it because it's essentially the same assets. Okay. Now we're going to look at some essential parts of this. One thing you need to see right now, the price of the stock of this ETF is $427 at the moment. Okay. And the 30-day yield as of December 31st is 1.21%. Okay, so because it's a very large portfolio, you don't expect to have a return that's going to be fantastic. Okay, why? Because some stocks will perform better than others. Okay. If Tesla has great news, whatever, Elon Musk discovered gold in his cars or whatever, the price is going to go up, right? So maybe, I don't know, the Tesla shares are going to go up 20% in one day. That's possible. On the other hand, because this fund is invested in Tesla, but in 499 other stocks, some of the stocks will go down in value, others will go up less, and so on. So basically, you're going to have an average return, and right now it's going to be 1.21% per month. Now, this is another interesting fact that I talked about, when people ask me questions about Wonderland and Olympus Forks, and they say, why is the price of the token so low compared to the net backing, the net backing? Okay, the net backing on an Olympus fork is the net asset value. Okay, so it's a premium versus discount compared to, like, if you look at it here, it says here. Okay. It's the premium or discount of the stock compared to the net asset value. What does that mean? Okay, this fund invests in 500 different stocks. Okay, and it's got, we're going to see that in a moment, but there's over $800 billion invested in this single fund here. Okay. So they have, millions and millions of shares of this fund that are sold to the public. Okay, so if you take 8 billion divided by the many millions of shares that you've got, you get 427.15. Okay, now that price should be identical to the market price theoretically. But there's always inefficiencies, and always, like, some people are bullish and bearish against that stock. So you're going to have some differences between the net asset value, the value of all the assets divided by the number of shares, that's the net asset value, and the actual stock price. And here we can see that there's a negative 9 cents. So that means that the shares right now are selling at a 9-cent discount compared to the net asset value. So you're paying 9 cents less, okay, than what you're actually holding in terms of value. So the price of these shares should be 425.24, but you're getting them at 427.15. They're 9 cents below their true value. That's what that means. So when you see an ohm fork, okay, that's selling, the token selling at $24, but there's $60 of net asset value, the backing per token, that's a net asset value, you're getting a freaking bargain. Think about that and stop complaining that the price of the token is low. At some point, people will wake the hell up, okay, and be less fearful. Right now, there's a lot of fear in the market. Let me show you the fear in the market because people don't understand what I'm saying. Fear Greed Index in crypto, Bitcoin. There we go. That's the one I want. All right. So if we look at the current Fear and Greed Index, all right, extreme fear, it's at 22 right now. When people have extreme fear, they don't know what the hell they're doing. They're selling tokens that have great value for less than the value that they hold. Okay? That's what's happening. If you're logical, you should be around the middle. When people are over here, they overpay. When they're here, they oversell. Get it? All right? Always look at this and see, why is Wonderland selling so cheap? Why is Hector DAO selling so cheap? Why is Honey DAO selling below its net asset value? That's the reason. Okay? And stop complaining that the price is low. When the price is low, it's time to buy. Buy so, sell high. You buy when there's extreme fear, and then you check this, and when it's in the green here, that's when you sell. Because here they overbuy. You sell when they overbuy, and you buy when they oversell. Very easy strategy to make money. Okay? All right, I hope that's clear. Anyway, so to get back at our ETF, the way it works is it buys shares of all the 500 top companies in the world that are listed on the S&P 500. So this is an example of the top 10 holdings. You've got Apple, Microsoft, Alphabet, and so on, Amazon, blah, 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 blah. All right, so they hold 500 shares, and these are the top 10 biggest holdings that they've got. As you can see here, there's over $856 billion in this fund. It's massive, massive. In comparison, if you want to see another fund, Wonderland is another fund like this. It's an investment fund. If you didn't know, I'm telling you now. Understand that. Wonderland is an investment fund. In its treasury right now, it's got over $1 billion. It's the largest treasury in DeFi anywhere currently. My feeling is that it's not going to stay as low as 1 billion. It's going to probably be 10 to 20 billion by the end of 2022. Okay? Just my personal opinion. All right. So now we have a basic idea of what an ETF is. Okay? And that's what these guys are doing. They created 3 ETFs. A low-risk ETF, a medium-risk ETF, and a high-risk ETF. And they contain these assets. Okay? They don't have... there's no S&P 500 for crypto yet. Okay? Maybe at some point there will be. But right now, that's what you're getting. So what's the advantage of this? Well, first, you're getting a really nice APY. Okay, and it's all done by the algorithm. The algorithm takes your money and splits it amongst these assets. These assets collect LP swap fees, okay, and what they do with them, they buy some YEL tokens that you can collect and do what you want with it. Okay, all right, so that's what they do. So we're going to do an investment on this, but let's look at the rest of the project and how it's actually working, and then we'll do the actual investment. So you you should definitely follow their Twitter. And here they were announcing that they were opening the ecosystem, the farming, sorry, on the Polygon ecosystem. So you can feel the power right there. And I kind of like this one. Okay, why it's not animated? There we go. So the guy says, so the highest APY and rebalance strategies on diversified investment, so don't have to do anything to earn money. And the guy says, hold my beer. Yeah, so basically it makes it dead easy to earn a very high APY. That's the whole selling point here. They take care of everything for you, okay? You don't need to worry about having a diversified portfolio. You already have one. And you choose the level of risk that you like. If you hate risk, take the low risk one. If you feel, oh, I need a little bit of risk, but you know, I don't want to go Frankenstein, so take the medium risk. If you're a total degen like I am, go Frankenstein and get the highest risk. Okay? So it's up to you. It depends on your risk appetite. Okay, and they're nice enough to offer you three levels of risk. Okay, and as you can see from looking at this guy's face, it's dead easy. Now they've got their Discord, which you should join as well. There's a lot of people in there, over 10,000, and they explain the different types of projects that they are invested in and their levels of risk. So you've got low risk over here, you got medium risk, and you got very risky. Okay, so we're gonna go very risky today. All right. Now they are audited. Amazing. Eh? So their smart contract has been audited here. They pass all the tests, so it looks all right. It doesn't mean it's not risky. As they said, there's low, medium, and high risk portfolios that they're offering you. Okay. High risk equals high reward. That's why there's such a high APY. You can lose money, okay? Despite the fact that it's audited, despite the fact that I think it's a good project, okay? If the market tanks even further than it did, yeah, it can lose money, all right? So be aware of that first, okay? Now, also, I have not found the multi-sig for this project, so maybe they don't have one, okay, which is a security feature that I wish all protocols had. But anyway, the project looks solid. They've been around for a while. It's not a young project. They've been around for several months, okay, so it looks okay. Be aware that there are some risk, and as always, don't put all your money on a single project, even though this is a diversified portfolio. Just in case something goes wrong, a hacker goes in there, a rogue team member rug pulls the funds, whatever. Okay, there's always a chance that something bad happens, so don't put all your money on a single project. Okay, so here they talk about how to do the investment. We're actually going to go through these steps ourselves, so I'm not going to read this one. What I wanted to show you instead was this article. So you need to know about the fees. There are some fees that are taken, okay? YEL Finance will be charging a 10% from the generated revenues as management and performance fee, okay? So they're taking 10% of the gains that you're making, okay? They're not taking that out of your capital, which is nicer, I think. All generated fees from the protocol will be used to buy YEL tokens. So all generated fees from the protocol will be used to buy YEL tokens from the market and allocate them to the rewards of enhanced pools or vaults. All rewards and withdrawals will be paid out solely in YEL tokens, meaning the equilibrium protocols will always trade earnings to YEL tokens before making payouts. This mechanism creates a constant buy pressure for YEL. Keep trading volumes high and benefit YEL liquidity providers with greater fees in their LPs. So this is not the normal farm. Like if you look at Pancake Swap, that's not the way they work. Pancake Swap will give you yield in cake tokens, okay? And they're just minting new cake tokens to enhance the yields, okay? In this case, what is actually happening? We've got these three strategies, right? Low, medium, and high risk. Each of them is invested in LP pools. The swap fees we're collecting from the LP pools are taken and are used to buy YEL tokens. So there's buy pressure, as the guy is saying, okay, on the YEL token. Because the more we're earning, the more we're buying YEL tokens. Okay, and that puts upward pressure on the price of the YEL token. You see? So it's not like cake that just issues tons and tons and tons and tons of cake tokens in their liquidity pools. Okay, they're not buying cake tokens, they're just issuing cake tokens. That's the big difference here. Okay. And again, it also benefits the liquidity providers for YEL, okay, because they are getting a lot more fees in their LPs, okay. So I kind of like this strategy better than the normal DeFi 1.0 liquidity pools, okay, and farm tokens. I think there's a chance that this works better. Time will tell. Okay, so please note that actualized returns may differ as they depend on selected risk levels, state of the market, farming opportunities available, and short-term factors like multipliers and boosters and so on. So that means your APY is going to change depending on a pile of factors. Okay, don't expect the very high APYs to stay very high or to stay at the same levels all the time, although they are trying to maximize those returns automatically for you. So they are maximizing the ROI by self-compounding. They have economies of scale and transaction fees by combining all depositors' funds in a single strategy for a given network. They occupy most profitable positions. They create buy pressure for the YEL token, which is good. This way your token doesn't shrink down to zero like Cake is doing right now. Increased trading volumes, benefit the loop demand ecosystem, simplifies market research and investment process. Yes, because you don't have to research 20 different protocols. They're all listed there. If you like those protocols and you already researched them before, and they do their own research as well, you just invest in the pool, in the strategy that has the pools that you like. Okay, so it simplifies your job quite a bit. All right. Yeah, so let's go and do the strategy. So what we deposit is Fantom tokens. When we are on Fantom, we deposit Fantom. When we're on Polygon, we deposit the Matic token. When we are on Binance, we deposit the BNB token. And I'm guessing when we're going to be on Ethereum, we're going to deposit Ether. So very easy, okay? You just deposit one coin, and they're going to split it amongst these LP pairs automatically. So let's go. All right, we got 37 Fantom tokens in there. So we're going to put, let's see, I don't know, 33. Let's deposit 33 Fantoms. Now it's waking up. All right. So we confirm. And does it refresh automatically or not? Let's check the transaction. All right, still pending. I don't know how long it takes. Oh, yeah, it's pretty fast. It's already done. And here's my position. At the moment, my position is worth $103, and my share of the pool is 0.01%, so not that much. It's a tiny investment. Think about it. That's it. It's that easy. I invested in this strategy, and now I've got my tokens spread amongst these 5 pools. That's it. That's all I have to do to earn 6,733%. Can't get easier than this. And that's why I like this strategy. Okay. Now, obviously, as I said, this is the high risk pool. You've got the medium risk strategy and you've got the low risk strategy. So whatever you feel comfortable with, you choose, okay? And all you have to do is deposit some Fantom tokens in there. That's it, that's it, that's it. It's so easy. All right, so that's it for this video. If you like this kind of stuff, please like and subscribe. Don't forget to ring the bell. Download the free book. The link is in the description below. All you have to do is put your name, your email address, and you hit the submit button. And you get a big fat button that says download the free book. And if you miss that button, we're sending you an email that says download the free book. And if you don't want the free book, well, go to Amazon, pay $5.99 to Jeff Bezos, and Jeff will send me a whole $1. See you.